Good morning, everyone. First of all, let me thank CFA Society for inviting me to this important discussion. First of all, some promotion for the CFA. Let me share my views on it. Um, I, in fact, happened to attend one of the CFA conferences in the USA about, I think, 17, 18 when I was a deputy governor. And then where I met a, a gentleman who was a medical consultant. At the age of 71, after his retirement, he had started to do the CFA. That's what he said with me when I met him over a lunch. And he completed CFA after the age of 70. After his retirement, then he formed his own private wealth management, what he has earned. Plus, he became a fund manager that managing, and he said he is doing much better than what he was doing throughout his career as a consultant in the USA. So then that basically got some interest in me as well. So being a central banker for almost 30 years, I thought, why not, even after retirement, why should not I try to do the same thing? So one thing what I realized, age is not a barrier to enhance your skills, especially in different area. That's what I learned. And also, in fact, after my retirement, during my retirement year in Australia, I bought all the study pack and almost about to apply for the stage 1 exam, and then I got the call. So hopefully after this life I might try again as a new life. So that's, I hope, is a promotion for CFA. It's not, age is not barrier. I would certainly say this is a good qualification, good exposure, good learning as a CFA. I think that's one thing I just want to share. In fact, then on this topic, rebooting Sri Lankan economy post domestic debt optimization. Let me share a few thoughts on this, plus some of our view on medium to short term, what we're going to see the next basically stage of development and stability. So, as he said earlier, over the past several weeks, the DDO process now has become a very popular topic. We have seen everywhere people are talking about, but now I think we are glad that we have announced it successfully. I say this is not a central bank announcement, it's basically the Minister of Finance as a borrower. They have announced. We also help to negotiate and propose what I see the best, most optimal strategy for Sri Lanka in terms of domestic debt optimization. So let me just talk a little bit about the history and how we came to this situation very briefly. For over 5 decades, Sri Lanka has not been able to maintain a healthy level of government revenue despite large public sector expenditure. Consequently, outstanding central government debt, which increased as much as in this year, 128% of GDP, which we see as unsustainable level of public debt, and that's where we basically were compelled to go for restructuring and restore this with the view to restore the sustainability. Especially over the last 2 years, the outstanding government debt had reached extraordinarily high levels due to debt servicing challenges arising from mainly low revenue mobilization, and also due to declining our foreign reserves, as well as very high fiscal deficits, over 11-12% for 2 consecutive years, and primary deficit of almost 6% compared to some small surplus we had 2 3 years ago. So historically, why we came into this situation? Sri Lanka graduated to the middle income country status in early 2000 because we had a good progress in terms of economic growth, and we were elevated to middle income. As a result, we basically had uh, reduced access to concessional funding, and also government didn't have low cost external funding, and that was replaced with high cost commercial borrowings. Since from I think 2007 onwards, commercial borrowings share from about 4 to 5% increased to over 50% in the recent years. Then obviously COVID-19 was another key turning point in deterioration situation. As a rollover, that high majority forex debt service obligations became infeasible with constrained access to financial market. We lost access to financial markets, threatening downgrades. Secondly, in 2022, government sought assistance for bailout package from the IMF, and also which essentially required to restore debt sustainability. That's where we started the process, announced debt standstill, and started negotiating the restructuring both first external debt and then negotiated the program with the IMF. We all know, I think we don't want to talk too much about it. So, the need for sharing the debt burden when it comes to restructure the debt, there was a need for sharing the burden of debt treatment between both the foreign and domestic creditors. So, if we are asking a relief from external creditors, obviously it's our duty to show that we also make a contribution. This is our debt, our government debt. It's not their debt. We are seeking a relief from external creditors that who have invested here out of their taxpayers' money and out of their pensioners' money, pension funds and hedge funds. So when we are seeking a relief, obviously we have to be our request must be credible, showing that we take all our efforts to restore the sustainability so that we can make good of debt service payment even with the relief going forward, and we have to show our commitment. There are several ways. One is by fiscal adjustments and committing to a fiscal target or primary surplus is one way to restore this sustainability, but that was not sufficient based on the parameters set out by the IMF to restore this sustainability, so that we had to do more. This is where now we have announced the DDO, and now we in the process of implementation, but still compared to the contribution in terms of DDO contribution compared to what we expect from external creditors, still almost half that we are contributing in terms of DDO, whereas we expect much higher contribution from external creditors. When we designed this program, I think I must reiterate that we remain committed to ensure the stability of the banking system. That is where while looking at the bank system stability, which is, I think I'm sure Jonathan will speak in his comments, why we need a stable banking system. It is most essential. Without a stable banking system, I don't think there's no point doing anything else. That's important. That's why we have come up with this strategy. So, going forward, the key expected outcomes of both DDO process and restructuring foreign debt reduction, which is basically to reduce the GFN, gross financing need, below 13% on average during the period of 2027 and 2032, and also bring down the public debt to GDP to below 95% by 2032, and also limit external debt service payments to around, on average, below 4.5% of GDP from currently 9.4%, which means almost half of external debt service payments that we have now obligations should be reduced to 4.5 from 9.4%. That's going to be a big relief in terms of foreign exchange balance of payment, as well as big relief for the liquidity for the government in terms of debt service costs. And on the domestic side also, from the GFN, gross financing need, currently well over 30%, will need to be brought down to 13% over a period of time through DDO as well as primary surpluses and other macro policies. And even obviously growth is also important variable that will help restore the sustainability. So now that the DDO process is underway, there arises a question of what's next. This is what we're talking about today. The Central Bank of Sri Lanka is obviously actively working with the government of Sri Lanka to firmly establish what we call macroeconomic stability as envisaged in the fund facility, the program that we have presented to the IMF, and they have agreed. So we have given our commitment. Now we have to deliver the commitment of maintaining overall macro stability to ensure we are moving in the right direction. In that, in the past, there are important other reforms. Not only the monetary policy is under back, but also fiscal consolidation and reforms to state enterprises. I'm sure Suresh will talk about it in detail. Those are two important pillars in addition to monetary and exchange rate policies. Two important pillars of the macroeconomic stability, medium to long term, that we have to deliver. It is expected that government borrowing in the medium term will reduce while the availability of credit to private sector investment will improve, thereby having a positive growth impact. So, whole exercise is that if you compare in the past, government has been absorbing a lot of domestic resources for servicing their debt. As a result, there was a crowding out impact on the private sector availability of resources from the local domestic banks and sources. So this is where going forward what we think with the DDO, there will be a lot more domestic resources out of the banking system, financial system will be available for the private sector on a medium to long term sustainable basis. So that will facilitate, that will provide opportunities, that will provide more resources for the private sector to grow faster and contribute to real economic growth based on private investment. So that is what is important. So far we have been relying on mainly public investment growth based on public investment. We have to change that model. That is why public sector demand for resources, both external and domestic, will be lower than resource gap. The external extra resources that would be generated, savings would be available for the private sector for the investment. This is why we think with our monetary policy actions, we hope that even cost of financing should be coming very low, both with our monetary policy stance as well as with more resources available for the private sector, as government will be demanding less, especially after completion of debt exchange. Remember, debt exchange will result government almost 5 years no payment of social treasury bonds and extended treasury bills by central bank, no repayment of the principals, which give a huge relief, and only interest payments will be serviced, so that there will be a lot of money funding available for the private sector. So another important aspect of the reboot process is obviously the latest one I can announce you. You all know the new Central Banking Act, which was passed after several years of efforts. Now finally we have been able to get it passed on the Parliament. Now it's a law, which will ensure our responsibility mandate to domestic price stability and also financial system stability, with having a lot more independence and also stronger accountability. It is not that only we get independence without accountability. We have much more stronger accountability provisions in the new law. Whatever we do, we are accountable to the people in this country, public, to the parliament, to the cabinet, to the everyone. So there's much strong accountability provisions with independence that we are having. So more importantly, this act provides what we call the necessary legal framework to adopt flexible inflation targeting regime. What does it mean? So this is the inflation in monetary policy framework that we have been informally having for some period, but there have been changes from some time to time. So, example, If you look at the inflation experience from 2009 onwards up to 2020, we were able to maintain around mid-single digit inflation by following similar framework in monetary policy implementation, but it was basically changed to what they call modern monetary theory in 2020 onwards. So completely, monetary policy stability goes basically created unstable balance of payment crisis and high inflation. So this act would ensure the framework would be stable, irrespective of the administration or irrespective of the members in the monetary board, appointed members. They will go through the same framework, and that will provide predictability and stability of the monetary policy framework. That's a very important um, uh, the formulation in the new monetary law act, and also this will address three key issues. What we had fiscal dominance in monetary policy in terms of Secretary of Treasury sitting in the monetary board. Obviously, his mandate is to reduce basically the reduce borrowings from the government side and reduce the cost of financing, interest expenditure. So there's a conflict against the monetary policy. As a result, there have been instances where fiscal dominance in monetary policy through Secretary sitting in the monetary board. We have seen in the past. Now it has been taken away by ST is moving out of the monetary board and have a much more representative monetary board going forward. And second part is to central bank ability in by law to finance government deficit directly through monetary financing, what we call subscription to tradable auctions by the central bank. That is one of the instruments that central bank had used for a long period and very heavily in the last 2 years, which caused huge monetary expansion. Now it is prohibited unless there is extreme circumstances with the approval of the parliament. There are safeguards. That's also the second part that will ensure, reduce or address fiscal dominance in monetary policy. And we all need to understand a lot of debate even in the parliament. There's a bit of confusion about the public finance and fiscal policy and monetary policy. I heard even parliament some making comments. Is parliament responsibility of the country's finance? They're talking about public finance under section 148. The constitution says is parliament has a responsibility for public finance, not the country finance, which is monetary policy. So there's still a kind of misunderstanding, but I think there was a good debate yesterday. I think that's what we understand. Monetary policy is about finance of the country. All of you are not only the government but also private sector, everyone setting interest rates, exchange rate is responsible for the monetary policy. Whereas government is responsible for public finance, which is taxpayers' money. How money is spent, how they collect revenue, how that is allocated for expenditure, and how they want to borrow for the deficit. That's fiscal policy by the parliament. So if there's fiscal dominance means government objectives would be overriding the overall monetary policy for the country, which will have impact on other people other than the government outside. This is why it's important to have separation of monetary policy fiscal policy while having a good coordination. This is a new monetary policy. New central bank has there's no ST sitting, but there's a coordination between fiscal and monetary policy through a coordination council, which is also institutional structure in the new law. And also the other important element is the to insulate monetary policy formulation from political pressures and ensuring more economic, financial, and operational independence that would help build the credibility of central bank in the eyes of the stakeholders. This is through proper appointment process of the governance members of the two boards. Now we have a new structure, monetary policy board and the governing board. Monetary policy board responsible for monetary policy implementation, which will have more experts in economics and finance, in addition to the standard governing board, which is dealing with financial stability, implementation, operational aspects of the central bank. So the appointing proper people, more suitable, there are provisions, there are law specifies the suitability of the people, professionalism, qualification, suitability, and also appointment process is checks and balances, is Minister of Finance recommends, and then going through the Constitutional Council that we did not have earlier, through bipartisan consensus, through proper process, and then finally executive appoints the members for fixed term, so that there is a stability of the term, so that members should not have to resign when administration are changing, because there's a stable period, so they can serve independently by that independence given by the given through this act. So that's about some comments on the latest act that we see now. We are now at the new act at the central bank. On the monetary policy front, now just talk about the inflation, this inflation process. As I said, we have talked about this a lot. When last year, a lot of people had concerns on inflation was rising, almost going up to 70%. Some thought it would be 100%, and there will be hyperinflation, and all these concerns were there. But as a result of very tight monetary policy, with a lot of criticism that we got from all of you, we were able to implement strict monetary policy, very tight monetary conditions. As a result, now we are in a situation where by end of this month, we will see single-digit inflation within a very short period, compared to 70% peak inflation September last year. By end July, we're going to see 7% inflation by end of this month, and it will be even lower going forward. This is where for monetary policy also very proactive. We are reducing the policy rates, and also once because we announced the DDO, that uncertain risk premiums that were factored in especially government treasury, government securities, is now is being adjusted. We hope that should adjust continuously going forward once we complete the debt exchange. So there are two prompts. One is the DDO has now cleared the uncertainty on treasury bills and bond rates, and the monetary policy stance have brought down the policy rates. So under normal circumstances, we would like to see, that's how in normal circumstances, 3 months treasury bill rates usually moving very close to the policy rates. Now it is 12%. And that adjustment still need to take place. This is where there could be short-term volatility. Last 2 weeks we saw primary bill rate, primary auctions bill rates so moving little in the other side. But I think because of the uncertainty on the exchange, once we complete, we should see under normal circumstances, first benchmark rates of government securities should fall in line with our policy rates, and then the other market rates that you are basically borrowing, should also have some premium over policy rates, but not like what we see now. This is where we have been asking banks to bring those rates down faster, because now obviously we have protected the banks and ensure financial stability. Now their role is to support recovery process, intermediary fund, more efficient financial intermediation through from depositors to lenders, so that under normal, we would like to see normalcy in the interest rates pretty soon. This I think we will wait for some time, a very short period, and then we will see. I think Jonathan will tell how he is going to bring down the interest rates in his discussion. Otherwise, we certainly will come back. I can assure you that, so we will come back, if not. And also on the external fund, external sector, this is other part I would like to talk about, this balance of payment issue. There also what we started when resource liquid resource almost zero last year. Now we have built up almost 2 billion. That is a business sufficient, because we are not servicing part of our external debt. But the whole idea is to restructure external debt is to have much lower obligations in external debt servicing, compare 9% of GDP to 4.5%. That will give a lot of relief in terms of balance of payment. Plus, we are seeing remittances, tourism obviously are improving. We hope the exports obviously have some impact because of the global situation. We hope that will be a temporary situation. Once global economic interest is coming down, there will be some recovery so that our exporters also stand to benefit. This is where also need to give some explanation on the exchange rate policy under new monetary policy framework. Exchange rate obviously is market driven, flexible exchange rate regime that you will have to understand now how to manage your exchange rate risk. Where under current monetary policy, what is our anchor is inflation. We are targeting inflation 4 to 5%. That is the anchor. So how we achieve that target is by using to address contain domestic demand. That is interest rate is the instrument to curtail domestic demand, and so that we can uh, achieve the inflation target on domestic side. But then prices inflation has an impact on external exchange rate also has an impact. So volatile exchange rate has a pass through to inflation. So the question is that when you have flexible exchange rate regime, how you would maintain the inflation at a stable level? That's a valid question. So the mechanism is that once you have inflation expectation anchored very well through credibility of the central bank policies and delivering what we have promised, that's what we are going to do in under new framework. The inflation is anchored and inflation expectations are anchored around 5%. Exchange rate volatility wouldn't have a significant impact on the inflation pass through. That's what empirical evidence shows us. What matters for inflation is mostly inflation expectations, not the exchange rate. Even if you look at direct impact of exchange rate variations to inflation is inflation basket, only 20-25% has a direct impact through exchange rate, through imported items. And even that 25% could be lower if inflation is expectations are anchored. This is why if you look at, for example, in inflation targeting countries, where advanced countries, inflation target is about 2%, 3%. But the exchange rate are market driven flexible exchange rate system, always appreciating, depreciating, changing. But inflation is anchored and inflation outcome is almost 2%. And we had a problem in the zero inflation also with exchange rate volatility. Why that is the case? Because the inflation targeting regime gives more credibility to inflation targets, and that create expectations and making decision, consumption, investment decision are not based on the exchange rate volatility, but based on the inflation projection and anchor. For example, the issue going to negotiate, your wage contract with your employees. So issue negotiate a wage contract on the basis of exchange rate. That would be a wrong wage contract. The wage contract should be based on what to think the inflation on the basis of 5%. That's why wage inflation spiral would not happen if we have proper inflation, credible inflation anchor. This is what is good about the inflation targeting regime. This is empirical evidence. An inflation targeting regime provides that anchor for anyone to do business, have more stability in your increasing cost of production so that you can do business. That is where your pricing, the margins should be based on your inflation expectation, not based on the day-to-day changes in exchange rate. That if that is the case, that would be a wrong business model. This is why we are saying this has been worked very well. That's why we want to establish this inflation targeting regime under flexible exchange regime. Then obviously short-term exchange rate volatility, obviously you're going to say there are instruments deal with that. That is why we need to develop the foreign exchange, local domestic foreign exchange market, so that there are instruments to deal with short-term foreign exchange volatility. For example, we would like to see more derivatives, like CFA guys, very better than me. What are the instruments, the options, forwards, swaps, other derivatives, so that one can hedge the exposure to the market, so that you can deal with that part and have some certainty, predictability under flexible exchange rate regime. That has to be the practice going forward when you are having this kind of multiple regime. I think that's an important change in the thinking and perception. This is why a lot of people, when I go to forum asking, we would like the stable exchange rate. who wants to do business, we would like to know whether the exchange rate will be 200 in next 3 years. That's what we tried for last and ended up and bankrupt the country. So it's not possible. Exchange rate will have to be determined by this is one of the instruments to stabilize economy. The imports are going too high and exchange rate is stabilizer. Then exports, imports, current account deficit would be adjusted based on exchange rate. This is important understanding in the new monetary policy framework that will be the framework going forward. And obviously, the other important reforms going together with, as I said, I think I'm sure Suresh Shah will be talking about the SOE reforms, and then obviously one important pillar is addressing corruption and vulnerabilities. Under the APIM program, we have committed that. I think we saw last week the anti-corruption legislation that was passed in the parliament. Hope that we have a proper implementation and effective anti-corruption regime going forward so that everyone can do better. I'm sure as CFA chart holders, you recognize the importance of ethics and good governance in doing business, not only by the government but also in the private sector. So addressing corruption and vulnerabilities has been one of the important pillars in economic development, medium to long term. Obviously, going forward, I think what I see now, in terms of stability, we have been able to achieve the stability in the short term. And next important step in terms of completing the stabilization program is to basically complete both DDO and external debt restructuring and signing a deal with external creditors, both commercial and bilateral creditors. We hope that we will be able to complete that somewhere by September, October, so that we can complete the first review of the program. So that once we do that, I think most difficult path of short-term reforms are over. Then we have to get ready for the normal under economic circumstances, how to boost the growth going forward and achieve a medium-term growth and recovery with low inflation, stable exchange rate, and higher reserves, and continuous policies and also strong growth enhancing structural reforms. So that is the only path that we want to go. And someone asked here in the morning, do we have to go to whether there will be a second DDO? If we deviate from the path, there could be a DDO. Again, there could be another default or bankruptcy. That's very clear. For example, now government has committed 2.3% primary surplus. If they go back to what we had minus 6% primary surplus, then there will be another non-sustainable situation. There could be a need for another DDO. This is why we don't need another DDO, because this DDO is quite strong enough and consistent with the targets to restore this sustainability, subject to the fact that other elements of policies, other policy paths should also move parallelly, both fiscal policy, structural reforms, and growth path. In my view, this DDO and restoring the sustainability is a much more conservative path if you do it right. For example, now this is based on the medium to long-term growth at 3% on average, but we are seeing Sri Lanka has a capacity to grow easily 4 to 5%. So if you are able to overperform higher growth and stable inflation, our outcome would be performance much better than what we think, and restoring the sustainability, we don't have to wait for 10 years. We can reach it in 5 years if we perform better. That's what we should target. I think given the base outlook is conservative, I think we have room to overperform, both in terms of growth, inflation, reserves, as well as fiscal, obviously challenging path. I must admit 2.3% maintain surplus is not easy. They have to maintain a very consistent fiscal policy going forward. I think I'm sure government has committed. Irrespective of what is government, this is the only path that I hope they will continue that path. If you do that path, I don't think we will be able to give much more relief to people who gave us relief in debt restructuring. earlier than expected, and we should be able to restore discharge earlier than expected. If it conversely, it's also true. If you move in a different path, instead of 2.3% surplus, go back to minus 4-5% deficit, then we will have need another DDO, or I mean that probably will be much more difficult. And that's, I hope that we will not go to that path, because we have strong commitment both from the fiscal authorities and the monetary authorities, and also from the private sector and everyone. So that we all need to ensure we remain in this path and be optimistic, and support we need from all stakeholders and public support to ensure that we move in the same path. Let me stop here. Thank you very much.